Welcome to the 3-Edge Week in Review for the week of February 13th. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge Asset Management. And joining me here today, we have a special guest who has been with us before. Glad to welcome Bob Phillips back to the 3-Edge Week in Review. And Bob is here with us today to talk about the recent developments in artificial intelligence, or AI, including ChatGPT and the potential impact of the most recent developments could have on our lives in general, and importantly, the impact that they could have on the future of investing. Bob will also provide an insight into how we utilize AI here at 3Edge in our proprietary model, including an interesting example of how we used AI in our model research to help us make a recent investment decision. Bob is in a terrific position to cover this topic. He's a co-founder here at 3Edge Asset Management. He's our Chief Technology Officer and member of the Investment Committee. And in his role, Bob is responsible for all of our investment modeling platforms. Bob holds several patents and has over 30 years of experience applying AI tools to solving complex problems. He has a BS in Mathematics Physics from the University of New Hampshire, a Master's in Engineering Physics from the University of Virginia, and a PhD in Mechanical Engineering from Penn State. So, my research indicates that through his educational background, Bob is a Wildcat, a Cavalier, and a Nittany Lions. So, welcome here onto the show, Bob.
Thanks for being here. Thanks. It's great to be here, Fritz. Appreciate it.
Thank you. Before we start, a quick look back at this week's activity. And, it was another choppy up and down week for equities. And, again, it seemed like by the end of the week, it appeared that maybe this narrative behind the rally in equities thus far in 2023 that, inflation will come down fast enough and it will come down far enough to allow the Fed to dial back monetary tightening and maybe even begin to cut interest rates later in 2023. Well, that narrative may not be able to hold. And investors may be coming around to the idea that, inflation just could be more entrenched than they once thought. Also this week, there were a couple remarks from members of the Fed that were fairly hawkish. Two Fed officials indicated that the Fed may need to consider larger rate hikes in the future. So, we're almost 2 months into the year. We're seeing that, the U.S. economy remains strong, corporate earnings fairly resilient, but inflation remains far too high. And all of that raises the possibility that the Fed is going to have to stay the course longer than the markets were hoping. So let me bring Bob in here and let's start our conversation about artificial intelligence, which has jumped onto the front pages everywhere in the last month or so, or a couple months. And in particular, we'll look at AI. Bob can talk a wee bit about ChatGPT in particular. And so maybe, Bob, if you could just start, clearly ChatGPT, that is the topic that everybody is talking about. So I think it'd be really helpful if you could just explain, okay, what is that? And, what is its potential impact going forward?
Thanks, Fritz. One of the holy grails of AI research going back to the earliest days in the late 50s and into the 60s was having a machine actually have a conversation with a person and do that in the context of some type of a real world scenario. Even back in the 60s, there was a tool developed at MIT called ELIZA, which sought to be a therapist for individuals and could do a very crude back and forth, but was pretty clear that if you went anywhere outside the boundaries of a very simple conversation, it had a hard time keeping up. And a lot of that was not for lack of an algorithmic approach, but rather just the amount of data that could be absorbed and the amount of computer power that was required to work with that data and really convert it into language. ChatGPT really breaks down into two key components. One is having the ability to access, index, and search a really wide array of data, most of which coming from the internet. And the second part is a model of language, often referred to as natural language processing. But then the really unique thing about the generative AI, which is the sort of generic term for what ChatGPT is doing, is that it can take all that information, consolidate consolidate it, look for links and connections between the ideas, and then produce through the language model a conversation, a prose-based response to a question. Now, you can imagine that for some rather structured things like haikus, for example, which I know a lot of people are having fun with, or a poem, or even sort of a regurgitation of facts, that can be pretty impressive. It really does. If you're and if you use search, as most everyone does, goes into Google sometimes several times a day to find things. Yeah. You know that today what it brings back is really a link to a source of data that hopefully answers a question that you have. And what this is trying to do is to take that same concept and really give you back a response, and then have a conversational interaction if you want to drill deeper or dig deeper into the subject. And that's very, very powerful, but it obviously is a challenging problem, and as was highlighted on the front page of the New York Times today, some of the conversations can go a bit awry because, again, you're not really dealing with a person, you're dealing with an amalgamation of data from the internet. And all of us know that some of the data on the internet is just not all that useful, and as a result, some of the conversations that you can embark in can be kind of strange and also not that useful.
Very interesting. And also, I think all parents are afraid that their children's term papers are now going to be written by ChatGPT. But anyway, so let's turn our attention now to AI and its potential impact on our world, on the world of investing. How do you see these recent developments in AI impacting the investment landscape?
I think in really two ways, at least in terms of the work that we do. Obviously, a big part of what we do is working with individual clients, helping them navigate what, as you alluded to earlier, a rather rocky investment terrain, but also more importantly, navigating them to achieve their goals and objectives and addressing what they have as concerns and risks. In order to really facilitate those kinds of conversations, we use tools like customer relationship management or CRM tools to capture data about individuals that will help us understand them and then really provide our team with meaningful ways to embark on conversations with the clients. Now, we don't foresee AI taking the place of the individuals that work for us doing that work, because a lot of it is looking for causal relationships, just not correlative patterns. But having the ability to pull together the data that we do have about an individual and make suggestions to our team about ways that we might be able to help that individual can be very powerful. And we think that's going to play a significant role as we move forward and help people in financial planning or wealth planning and in other areas. And again, it's that ability to look across broad arrays of data and then find the linkages that bring the data together in an appropriate way and in a more personalized way for an individual. And that can be very powerful. So that's one area where we see it having, frankly, a fairly quick impact over the next few years in the work that we're doing. The other area is an area that we've been working on for a very long time. As many of you know, if you've been listening to these wonderful videos and hearing Steve and Fritz talk about what we do, we have a model of the global capital markets, and it has three primary components. One is looking at the valuation of an asset class, very long time frame phenomena. Typically falls into three categories. It's either overvalued, undervalued, or somewhere in a fair value region. A second area is in the economic components and the causal relationships related to things like changes in interest rates and yield curve slope and other areas. And that gives us an intermediate term view of the markets. And then the final area is the behavioral component of our model, which tends to be shorter term. And by shorter term, we're not talking about days or minutes here. We're talking about months. But nonetheless, sometimes things can happen on a behavioral basis in the market that are a little different from what you might see in from longer term views or very long term views and valuation. But they all play together. They're all part of this large nonlinear system that we model. In the behavioral side, what we do is we take the inputs from the valuation model and the economic model, and we use those to look to identify behavioral patterns in the market. And we often talk about bucketing the behavioral patterns into, say, three regimes. One is a rally regime or a correction regime or a buffer regime somewhere in between. And then within that, we have logic that defines various types of patterns that we can detect in the market. And those patterns can give us an idea of, okay, something may be happening that we want to take advantage of that's reflective of the state of the market as projected by the economic and valuation variables.
And that's just, if you just think about that, that's so impossible to believe you could ever do in your head, right? I mean, you need the computing power to do that. So next question, or I think you have an example of where AI played a role in specific investment decisions. So maybe you take us through that. I bet that'd be very interesting.
Yeah, I think that's really important to understand how it really plays a role. So last October, our model started to show us that in emerging markets had been undervalued for a very long period of time. When the U.S. markets were running really hot over the last several years, emerging markets just stayed relatively flat or down, and so they were undervalued, significantly undervalued, particularly relative to the U.S. markets. Also, at that point in time, the emerging markets had been pretty beat up from an economic perspective, very influenced by changes starting to occur in the U.S. Obviously, the COVID lockdown in China had a big impact. So there were a lot of negative things going on in those markets. But in October, the economic projections started to change slightly as the Chinese economy opened up, for example, as India started to move a little bit faster. And so those were the things going on in the valuation and the economic projection. And from that, we take those two components and we put them into the behavioral model, which is, again, this logical bucketing exercise to say, has there been a pattern like this in the past? And if so, what was the return effect of that pattern? Right. And in that particular point in time, what the behavioral model was saying was, yes, things are pretty beat up, but given the inputs of valuation and economic projections, they're behaviorally, this is when emerging markets start to turn around. And again, the beauty of what we do, unlike very black box kinds of other types of pattern recognition and AI, ours is based on a very solid logical framework, and we can go in and really look at those patterns when they've occurred in the past. And again, this is all part of using the AI tools to really extract patterns from data that allow us to look at when those patterns occur, to assess, did it ever happen? Did it only ever happen once 50 years ago? And is that really, can we really trust it at this point in time? But we looked at that, and it was a pretty solid, logical relationship that had held up several times in the past. And so the investment committee decided to go forward. We put in depending on the strategy, we put in an emerging market investment. If we had just been relying on the economic and valuation, we would not have seen that opportunity when it occurred. And then obviously other things caught up, and economics caught up. We came up out of undervalued situation, but so that changed as we went forward. But having that investment in November, December was really important for us. So.
And actually, from my standpoint on the investment committee, where I'm less involved in the actual technology, it was very cool to see how excited you guys were on the research team when that information started.
We love to find those kinds of opportunities, because it really is. Again, it's really that the culmination of all three parts of the model working together to really help us identify opportunity.
Excellent, Bob. Well, thank you very much for all of your insight into this new area in AI with ChatGPT and the like, how that can affect the investment management world and how we utilize AI. And I think one benefit of this video is that, one, our clients get a better understanding of all the quantitative firepower that you and Eric and Steve bring to the investment process and just how important that is to what we do. But at the same time, as you said, we know why the model is telling us what it's telling us. It's not a black box, so you guys can go back in and take a look and see. So on behalf of Bob and me, that will do it. Steve and I will be back next Saturday with another edition of the 3 Edge Week in Review. All our videos always available on our 3 Edge YouTube channel. You can go to YouTube, type in 3 Edge, and you will see them there. And in addition, all our videos, all of our written comments are always available on our website. And our website is 3edgeam.com. So until next time, on behalf of Bob and everyone here at 3 Edge, thanks for listening.